Hi traders, Luke Suddards here, market analyst at Pepperstone, joining you from a wet and miserable London. Now the two key market events for this week, we've got OPEC up on Wednesday and we've got the non-farm payrolls out on Friday. Now the non-farms payrolls on Friday, what's going to be really important there is to see how strong that job gains number is, because that's going to feed through into the market's expectations into how aggressive the Fed may be in terms of their taper timeline. And that will obviously feed through into asset classes such as the dollar, gold, US dollar, JPY, those asset classes that have a high beta and sensitivity towards rates. So without further ado, let's get stuck into the charts and have a look at the key price levels and what we need to do. It'll follow the same basic structure that we always do here at Pepperstone, whereby I will run through a couple of the fundamentals and then we'll spend most of our time in the nitty gritty of those charts. So let's get cracking. Okay, so on the dollar, in terms of the fundamentals, positioning data showed a significant spike in net long dollar positioning, $7.5 billion to be precise. This was 3 days before Jackson Hole last week, Tuesday. I tweeted out on Friday after the event that some of that pre-Jackson Hole hawkish dollar positioning had been unwound. It was a bit of a buy the rumor, sell the fact kind of day. The data now confirms this was the case. I didn't have the positioning data at the time, but I was assuming. Manufacturing PMI numbers out on Wednesday in terms of data for the US, and we've got the ADP's private payroll data, which is kind of like a preview for the non-farm payrolls. However, I think forecasting accuracy isn't the greatest, so you've got to be careful how much weight you actually put on those ADP numbers. Then we'll have jobless claims data out on Thursday as per usual, and this will add to the market's thinking before Friday's non-farm payrolls release. It's a tough one to call really because you have jobless benefits rolling off, which should boost hires. However, the Delta flare-up could counteract this. High-frequency labor data I've been seeing has been pointing to a slowdown in hiring activity. The health of the labor market is the main factor influencing the timing of the Fed's taper decision. We've had a chorus of hawkish Fed officials on the wires the last few weeks pushing an aggressive taper timeline. The Federal Reserve, they're actually expecting, it's baked into their assumptions now, they're expecting to see additional progress on the job market recovery in the coming months. So I think the next 2 months jobs data needs to be really solid. For this Friday, consensus forecasts are around 750K job gains for August. We know inflation progress has been met. We're just waiting for that progress now to be met on the jobs data. And I think if we do see 2 solid months, that will meet the benchmark for the Federal Reserve. Powell and now most FOMC members now see this year as being potentially appropriate to begin reducing asset purchases if the economy evolves broadly as expected. So let's get into the charts. So as we can see here, the dollar's actually dropped slightly below its 50-day simple moving average. It's trying to hold it there. We can see the low of that candle. There's a tiny bit of support around here. It's right at that 92.5 level, that round number. So we'll see what happens here if it can hold that level. Below that, I'd start to look at 91.958, which is about 92. The round number, there's a bit of support there previously. I've drawn a little dotted line there, and then below that I'd start to sweat if I was a dollar bull a little bit as price gets close to the 91.5 and 200-day simple moving average. I'd like that 21-day exponential moving average to stay above and not cross below the 50-day simple moving average in terms of keeping that short-term bullish momentum intact. In terms of upside targets, I'd look at 93, the round number, and then above that, the previous high back in 31st of March, which was 93.4, as well as the 20th of August high of 93.729. Again, we've got a bit of that negative divergence. It's breached the 55 level. There's another tiny bit here where we saw that dip there and it held the bullish trend. So we'll have to see what the RSI does around this 44 level too. Then as we move on to the euro US dollar, let's take a quick look at the fundamentals. So there was a $4.8 billion cut in net euro longs. It was the largest 1-week move against the euro since mid-2018. That's what actually made up the bulk of that dollar change in positioning. preliminary inflation data out from Germany was in line with the expectations on the year-on-year measure, but missed on the month-on-month figure by 10 basis points, i.e. 0.1%. Employment data out from Germany just this morning was solid. It beat expectations. We'll have inflation data out from the Eurozone as I'm recording this, and we'll have retail sales from Germany on Wednesday morning, bright and early. And then we have manufacturing PMI from all the major Eurozone economies and the Eurozone aggregated figure, as well as the unemployment rate. The manufacturing PMI numbers are final estimates, though, so there shouldn't be any major surprises there. And then Friday brings the final composite and services PMI numbers, but this will be overshadowed by the NFP report. So looking at the chart, we can see the euro still stuck in this. Let me just move that there to make sure that you can see it. So we can see now that the euro is stuck in this descending channel, but it's right up against that upper trend line of its descending channel, and we need to see what price does here now. We've got the 118.5 horizontal resistance slightly above. It's just above its 50-day simple moving average. We still do have that death cross, which for me indicates that the bearish momentum is still in play. It has surpassed that RSI 52 level, which is quite interesting. And the 21-day exponential moving average does look like it's trying to turn up slightly there, and potentially cross with the 50-day simple moving average. I still think that, for me, the euro US dollar is a good currency pair for shorting the rallies. However, you've got to play the tape on this one. And if we do see dollar weakness building into that non-farm payrolls number, and there is actually a weak number, we could see the euro US dollar actually breach through this horizontal resistance and go on to 119 potentially, and then hover around this gap between the 200-day simple moving average and that 119 level, sort of between 120 and 119. On the downside, though, in terms of short targets, if I'd be looking around here, these sort of areas, to potentially look at something like that. And in terms of downside targets, I'd be looking at 117, the 21-day exponential moving average and the 50-day simple moving average as potential targets. Moving on to cable. Just covering the fundamentals before we move into the charts. So we had net long position in the pound, flip net short, $1.4 billion. There was a big increase in gross shorts in the pound. Manufacturing PMI final numbers are out on Wednesday, and then we also, similar to the European Union, we get final composite and services PMI numbers out for the UK on Friday too. And again, it'll be overshadowed by the non-farm payrolls. There's not really much fundamental data out for the UK this week. The death cross looks very imminent here. The 50-day simple moving average is only very slightly above the 200-day simple moving average. And if that was to occur, we could see further pressure applied to the pound from those technical traders, the systematic algos. For now, price gains are being capped by those two moving averages on the upside, and there's that horizontal resistance of 138.5. The RSI is quite close to that 53 level, which has marked the previous price rally there. We can see it just got above there and then came back down. It's going to be interesting to see what price does again, like it did there back in early August, as it hits that 200-day simple moving average. If we get some candles hovering above here, and if the short sellers come in. There's a lot of support here, though, quite strong support. We had the double bottom back in March and early April at 136.6, and then below there we got another semi-double bottom around 20th of August and the 20th of July at 136. Moving on to Euro GB, US dollar JPY. It's been quite a boring, dull currency pair to trade at the moment. It's just been very range bound, particularly tight ranges, because the US dollar, the US 10-year, which should take so much direction from in terms of movement, hasn't done a lot. And we're hoping maybe this Friday we can see some movement in the US 10-year yield based off those non-farm payroll numbers and get a bit more life into the dollar yen currency pair. Right now, the 50-day simple moving average is capping those gains for upside price moves, and on the downside, we've got this 109.1 support, and on the upside, we've got the 110.8, 111 resistance. The RSI has moved back into this tight little band between 58 and 46, and we'll need to see a breakout in either direction in terms of confirming price action. Now, EURGBP is looking very interesting. You know, it's right at this former range support here where price was just bumbling along. It's right up there. It's peaked its head slightly above it. The RSI is above this tight band at 52. But yeah, another one for me, like shorting the rallies on this currency pair, just because, you know, the European Central Bank are going to remain so easy for so long compared to all the other major central banks, the Bank of England, the Fed. And for me, that's a structural, going to be a structural driver for Euro GBP, multi-year divergence in central bank policy. So in terms of targets, there is a tiny bit of resistance here at 86. We can see on those highs of those price candles, the wicks there. So it'll be interesting to see if price does move a couple pips higher from here. But it's about 25 pips, sorry, 125, 115 pips from here would hit the 0.86 mark. And we could potentially see price stall a bit up there. Another candidate shorting the rallies. In terms of targets, yeah, 0.86 on the upside. On the downside, I'd look to come back here to the 50-day simple moving average about 0.8546. Further than that below, we've got the 0.85 round number as well as the upper trend line of the descending channel. I want Euro GBP to move lower. I've got a holiday coming up in Spain soon, so I really hope it does move lower. Moving on to the old Aussie dollar, US dollar currency pair. If we just, while my charts have all jumped this morning, apologies about that, having to correct it mid-recording. We can see the Aussies actually rallied quite well off that 0.71 low, and it's now back up above that 0.73 round number resistance, back into this little, we had a little range play out here early July, August between the bounds of 0.74 and 0.73. Price is just above that now. We could get some resistance as it hits that 50-day simple moving average if it rallies a bit harder. We're also coming up to that RSI 55 level where price peaks were shorted as price got up there when we were in that major range back there earlier in the year. On the downside, again, targets, I'd look to about 0.72 and lower than that, 0.71. And see what the RSI does around here. And upside targets would be the top of the range resistance in the 50-day simple moving average. Looking at the Aussie dollar, New Zealand dollar pair, we can see that, you know, we had this massive spike lower this morning. What did it get down to? It got down to a low of 1.0345. The Aussie strengthened a bit since then and pushed it back up, and we're still below this little range we are trading in. In terms of targets, the 103 seems good to me. If we zoom out a little bit further, you know, 102.50 would be the head and shoulders target projected downwards, the technical target. Again, we've got a little bit of negative divergence here. As the price makes lower lows, the RSI is making higher highs. It is rolling over slightly now, though. Looks like it wants to move back into oversold territory. And yeah, it's below that 44 level, which has marked previous price rallies here since the beginning of August. On the upside, I'd be looking for price to get back to that 21-day exponential moving average and the top of that little mini range resistance at 105 going forward. Interesting currency pair, nice and volatile, that's for sure. Moving to commodity land, we've got gold. Gold's looking really interesting. Just wanted to see. Oh, on the Aussie, what I wanted to mention in terms of the fundamentals, net shorts are now 4.1 billion. It's the largest bearish position in the Australian dollar since September 2019. We've obviously got that important Aussie data out on Wednesday, sorry. We've got GDP data, but we got Q2 business inventories out, and it missed expectations by a lot, printing at 0.2% versus the 1.3% forecast. And that will feed through into the GDP numbers out on Wednesday, where forecasts are for 0.5% quarter on quarter. It's not a particularly high bar to beat, but restrictions will most certainly weigh towards the end of Q2. And those weaker business inventory data numbers will also feed through into GDP. How large its influence is the big question there. So just moving back to gold where we were, it's sitting on its 200-day simple moving average. It's got above that 55 RSI resistance, which marked the double top there. Maybe we're going to get another triple top as price rallies back up to this 1830 horizontal resistance. For now, the death cross is still in place, although the 50-day simple moving average and the 21-day exponential moving average have both turned up. It'll be interesting to see if the RSI can maintain the 55 level here and stay above it. Non-farm payrolls on Friday will have a large impact on gold, or at least it should. In terms of upside targets, 1830 would be my first one, and then above there it would be 1860, where we've seen some support there earlier in the year. On the downside, 18 seems a good level. Just below that, you've got the 50-day simple moving average, which could bring some buyers back in. And if we see further weakness, it could fall to 1750 horizontal support in terms of downside targets. Oil has been very interesting of late. Just gonna get that chart back there. Yeah, it's been very interesting. We've seen some really large moves with that 65. It moved up over 10% last week off that 65 support level. A bit of weakness today. We've seen the RSIs rolling over a little bit from that 58 level. In terms of oil fundamentals, there is a bit going on, so I do feel it's necessary to speak about it. As much as 95% of oil production in the US section of the Gulf of Mexico has been shut in as Hurricane Ida passed through. That's the equivalent to about 1.74 million barrels in daily production. Now, price has come off the highs just shy of $74, as it is now expected oil production may return before refining production. Now, what that means essentially in layman's terms is oil production equals supply, refining is demand. So if refining is going to take longer, it means demand is going to be slower and you're going to have more supply, slight supply-demand mismatch. However, since Hurricane Ida hit land, has been downgraded to a Category 1 hurricane, so it doesn't look like it's going to be that damaging. We've also got the EU announced last week that they've banned now non-essential travel for travelers coming from the US, so that could hit jet fuel demand a tad as the travel season starts to fade as we move back into the winter months in the northern hemisphere as summer comes to an end. We've also, as I spoke about earlier, we've got the OPEC Plus meeting on Wednesday, and it should see, in my opinion, the status quo schedule on track for 400,000 barrels per day returned every month until that 5.8 million barrels per day cuts that they made during the height of COVID are returned. I think OPEC Plus will feel far more comfortable with where oil is priced currently to add more supply to the market as planned. I mean, if we were back at $65, then maybe they might have been a bit more nervous. They don't face the prospect of imminent supplies from Iran as talks to lift US sanctions have stalled a little bit. It's been very quiet on that front. And I think, if global demand evolves as anticipated and the rate of supply increase continues from here, there'll still be a deficit between demand and supply. So let's get into the charts. So as we can see, the 74 level resistance there has worked. The RSI 58 for previous price rallies peaked there a little bit, and it's caused price to come down, roll over a tad. In terms of targets, I'd say the 21-day exponential moving average could provide a tiny bit of support. Lower than there, we've got the 70 round number, which should help. And from there, we've got $68 and then back down to 65. But that would be a very strong downside move if we were to get back down to 65. I think I'd be more likely to see price come back down here between these two levels and potentially continue its uptrend move further. In terms of upside targets, the 74 is obviously a key one. We've also got a tiny bit of resistance here at about 76, and then we've got the previous ascending channel trend high at about 77.80. Finishing off as we do usually, keeping to the schedule, we've got Bitcoin. Bitcoin is in a very tight range for such an explosive and volatile asset, between 46.5 and 49.2. Between the 200-day simple moving average and this horizontal resistance, which was former range support back throughout earlier this year. Above there, if price gets a little bit higher, we've got the 52.7 horizontal resistance, which would be my upside price target above the 49.2K level. Below there, if it breaks below the 200-day simple moving average, you've got a tiny bit of horizontal support here at 43.944, and below there we've got the 50-day simple moving average, as well as the former range resistance at about 41.5. That's it for today. I hope you've enjoyed. Keep your fingers on the pulse this week, because things could get interesting with those non-farm payrolls, that's for sure. Thanks for joining.